Alright, we're back with the business strategy game. This is Austin coming at you. Let's talk about what's going on. So, this is the day of the last decision. We are about, two and a half hours away from locking this in and finding out the final results. So, just to show you guys where we are at right now. Coming into this final section, we are in first place, Asylum Footwear, that's us. We're neck and neck with the BZs. They're trying to take our crown, and we're not going to let them have it. And that's how we're playing this game right now. Cart Company, they were in the mix for a while. They were kind of right there with us, and then I don't know what happened. They sold their capacity. They really scaled back in a lot of markets. They don't have the ability to get really any sales other than their market. In fact, my prediction for this year is they can't even maintain their current market share. So they just don't have the capacity to meet the demand that was put on them last year. As you can see here, they sold capacity in North America, they sold capacity in Asia and in Latin America, which reduced their total capacity down to 4,300,000 shoes, which after their overtime gives them, I think, like 5,200,000, somewhere around there. Whereas you can see just the massive amounts of production the rest of us have. Now, you can see that the analysis here is there's a good amount of supply and demand given capacity with overtime, but yeah, they said that if we can purchase capacity, that we should think about that to meet future demand. Now, this game's ending this round for us, but that just lets you know that they're expecting the market to continue to grow. So when you're looking at your market research, looking at the overall market growth, what the market growth is projected to be, also trying to understand what's driving that growth. So if you can see anything down the line, anything down the value chain that might change the growth from its projections. I mean, if you understand what goes into that, you can predict that, or at least try to forecast that, so you know what to do when you're talking about expanding your capacity. That can be an expensive option for a real company. So something to keep in mind. Now, how do you win the game? You win the game on 5 different metrics. So it's earnings per share, return on equity, stock price, and image and credit rating. So just kind of looking this over, right now we're ahead in earnings per share. We had been actually for a while ahead in earnings per share. Return on equity, we're ahead with the weighted average. Our stock price, we're ahead. So on those metrics, we're ahead. We have momentum, and we have capacity leadership. When looking at the final ratings, credit rating and image rating, these could go either way. Now, they are ahead of us on image rating, and since they're looking at a 3-year average, I mean, they're telling us right here looking at a 3-year average, we can't catch them. These guys have been the image leaders since the beginning of the game. I don't really see us these guys are the corporate responsibility award winners. I don't see us really catching them as far as image is concerned. And when it comes to credit rating, they're pretty much neck and neck with us. So if they have a good year, they could go to an A, maybe even an A plus. We're gonna go to an A and A plus, so that can wash out. So I'm banking we're gonna beat them in credit rating, but we could tie their image rating. They're gonna beat us, but it's not gonna be that many points. If we can beat them on the 3 financial metrics, we should have this in the bag. Shouldn't really be a huge deal. Now let's take a look at where we are from the market snapshot. Last year was interesting. So we didn't know, because that last year was the year that cart companies sold their capacity, and I think they raised their price. Nope, they kept their price the same, $56. I think they raised it. They raised it 2 years ago, and I think they raised it in some markets. Let's see if they raised it in Europe. So they were at 57.60 in Europe. They stayed there. They raised it in Asia, and they raised it in Latin America for sure. Which, raising your prices to $60 for the wholesale market. So this is the wholesale. This is what they were wholesaling to retailers for. Retailers are then going to mark it up beyond that. So I mean, if they're selling their shoes, I mean they're definitely trying to get margin, which is smart. But at the same time, they're dumping so much market share. I mean, they are basically trying to bow out of the market. And in fact, you can see a lot of the demand shifted over to us, and even over to Company D. Company D is a zombie team. They basically, no one's running that team. It's just kind of operating in the background, more or less as a just kind of as a benchmark to show you what would happen if you did nothing. We had the same thing in our operations simulation. We had a zombie team, and it at least in this simulation, it throws off the market because the market's dynamic. In operations, I think it was static. So, you know, each company was operating independently of the others. We were just scored against each other in our operations simulation. But in this simulation, the market's dynamic. So, you know, Company D being there definitely affects the game, and it affects how you play the game. Just something to keep in mind if that happens in your game. So, so really right now, card companies out. Company D is where it's at. Sorry, they're not where it's at. Company B is where it's at. Company B is our competition. So looking at our where we are strategically from them on the strategy map, we have more models available, and we're neck and neck as far as quality goes. We didn't start off in this area, and I would not recommend someone else use this strategy. In fact, as I'm writing my report now, I'm recommending people do not follow our strategy because it's expensive. Now, we have been able to attain cost leadership in in our Latin American facility, but not in our Asian facility. And that's just because this is a really bad strategy to employ if you can avoid it. But the other strategies were taken by other companies in the beginning. Let me show you what happened. So yeah, so as you can see, we wanted to have this strategy right here. They took it, and we really didn't feel like trying to battle them back for it. It was really putting a huge drain on our resources early. As you can see, Card Company took a huge lead right off the bat because we were busy fighting each other in this little market space, and we decided that we needed to differentiate or be crushed. As you can see, Card Company continued to grow. BZs were larger than us, just soaking up market share, and we had to get out. We had to figure out a way to carve out some sales in this region. This is 4 years in a row that we were just getting decimated. We were right at 20% of the market. And here we grew to 24% of the market in year 15, 25% of the market, 31% of the market, 37% of the market. So I mean, as you can see, as we differentiated, we really started to come into our own, and now we're here stuck at 32% of the market because Company D grew after Card Company settled out. But yeah, I mean, differentiation is a strategy that can work. It worked well for us, but again, this is a bad strategy. There are other strategies that were more attractive that we could have tried to employ. We just would have been fighting other companies, which wasn't what we wanted to do. So, you know how the game is scored. You know what we're trying to do, which is trying to beat the BZs and come in first place. How are we going to do it? So, my prediction is that there's only a couple of moves they can make. So they can lower their prices. If they lower their prices, that would increase their demand. It's not going to increase their capacity, which means shoes are going to come out of private label, and they're going to go into the branded area. Now, as you can see, Company D is making significant inroads into market share because Company C can't meet their demand. So if they decide to put their shoes here, it's going to leave an opening for us here in private label to gain some earnings per share. They could raise their prices, which is going to increase their margin and get them more net revenue, which I think is going to be a good thing for them to do. That would lower demand. That would lower demand for them, and I would have to shift demand elsewhere. We're also raising our prices, which is going to lower demand for us and shift demand elsewhere. So eventually, Company D, they're going to run out of capacity, or sorry, they're run out of inventory. If they run out of inventory, then the market's gonna have, and car company runs out of inventory, then it has to come back to us. So if they raise their prices and we raise our prices, I mean, we pretty much are going to end up with a wash after company D takes all of their market share until they run out of capacity. Or sorry, until they run out of inventory. I don't know how much inventory they have, so that would be interesting to take a look at. Now, so those are two options. All right. The third option is that they forego the wholesale segment and pump a bunch of shoes into private label. The thought there is that they think that since we have capacity leadership, that we're going to go high in private label. Since we have so many shoes, we know they can't fill the market up. So and keep their wholesale segment. So if they just forgot about their wholesale segment and went whole hog into the private label, if they assume that we went high, they could underbid us by a few dollars. Let's say that they think we're going to go for $40, so they bid for 38, 37. They're going to get significant margin on all of those shoes if they're right. But it's a huge gamble for them, because if we underbid and we flood the market at $10, which we have done before, we're going to take a loss on the market, but we'll completely shut them out of private label, and we have the capacity to do it. It's a huge gamble. What I think they're going to do is I think they're going to try to soak up Company D's market share. So I think they're going to go after Cart Company and Company D's market share. I'm pretty sure they know that we're going to be in private label with some significant capacity. I think they're going to try to sidestep that and use their celebrity advantage and advertising. They're probably going to lower their prices and allocate most of their shoes in the branded sector. So it's going to give us a tough time in branded distribution this year. I actually went ahead and I allocated more inventory than we needed, just in case they do another strategy, just in case the stock outs. But even if we end up with this in inventory, it's fine. We still have a decent earnings per share predicted here. We're assuming that we get some bids here in private label, but even if we don't get the bids in private label, we're still doing good on earnings per share. We're still doing good return on equity. We still have a great credit rating. Our image rating takes a hit, so we would not beat them on image, but we may be able to beat them in 4 of the 5 metrics. Even if we get shut out here, I don't think that's going to happen. I think it's good. I think it's a good idea that we don't count on these sales, but I think we're going to get them. And we're bidding middle of the road here in private label. And the reason that we're bidding middle of the road is because we're trying to put significant downward pressure on the market, so that if they come into the private label market and bid high, then we're going to take up most of the market. So hopefully they're going to have shoes that just go unsold in this market. Now, in the event they go into private label and they go low and shut us out, that's fine. They're going to take lower margin and less profit than they would if they had placed those shoes in the wholesale segment. As you can see here, I've got much higher margins here than I've set myself in the private label market. I could have been greedy. I could have gone and tried to get higher prices in private label. I just don't know what they're going to do, and we're too close to call. If we had some greater distance between us in terms of the final scoring, I probably would play a little bit more aggressive this round. But really, I mean, I'm really just trying to squeak across the line, be the best company, and then, you know, like every millennial, I want to sell my company for a profit and ride off into the sunset. So if I can get the financials to work out, someone's gonna come acquire me. I can sell to Facebook or something like that. You know, sell to Zappos, sell to Amazon. I don't know. Sell one of those companies. I don't know who the hot shoe company is right now, but yeah, that would be the plan. So that's what we're gonna do. We have minimal bids in for celebrities. We haven't really seen them make a significant impact this time around, and yeah, we ended up taking a loan just to give ourselves some working capital to make sure that we were able to achieve our credit rating. So yeah, I mean, everything's looking good. I don't know why we have this potential for overdraft. I think it's because we selected to put in this here. I don't know what it is, but we're gonna fix it. We don't have anything to worry about, and we're gonna go from there.